Most people don't get ruined during recessions. They get ruined just before them, when they still believe the sky's the limit. Warren has spent over 6 decades observing how markets behave and, more importantly, how people behave within those markets. He's lived through deep recessions, he's seen collapses that seemed like the end of the financial world, and he's witnessed recoveries that nobody anticipated. He's been in the room when solid companies were selling for pennies on the dollar because panic had replaced reasoning. And he's also seen, time and again, how intelligent individuals with good intentions and considerable resources destroyed themselves financially, not from lack of knowledge, but from excessive activity and absence of preparation. I don't speak from a textbook. I don't speak from academic theory taught in universities. I speak from the trenches of having made real decisions, with real money, during real crises. I've made mistakes, I've learned from them, and I've developed a deep conviction about what works and what doesn't work when the waters turn turbulent. When people ask me what to do before a recession, they expect a formula. They expect a list of stocks to buy, sectors to avoid, or some kind of sophisticated technique that will allow them to dodge the storm. But the truth is much simpler and, paradoxically, much harder to execute. The number one strategy before a recession has nothing to do with predicting the future or frantically moving money from one place to another. It has to do with something far more fundamental: liquidity, balance sheet strength, and emotional temperament. Let me be clear. I cannot predict when the next recession will come. Nobody can. The brightest economists in the world have consistently failed to anticipate the exact timing of economic contractions. I've seen people lose fortunes waiting for a crisis that never came, and I've seen others get wiped out because they assumed the good times would last forever. The market, in its essence, is unpredictable in the short term. But there's something we do know with certainty. Recessions come. They've always come. They will always come. They're a natural part of the economic cycle, as inevitable as the changing seasons. The question isn't whether there will be another recession. The question is, will you be prepared when it arrives? And this is where most people make their biggest mistake. In times of prosperity, when everything's rising, when neighbors are bragging about their gains, when the media celebrates new all-time highs, the temptation is to leverage up, stretch that last dollar, invest every last available cent. After all, why hold cash when that cash could be working in the market? This mentality, so common and seemingly logical, is precisely what destroys wealth. I've learned over the years that cash isn't trash. Cash isn't a dead asset. Cash is optionality. Cash is oxygen. When everyone else is desperate, when excellent companies are selling at ridiculous prices because nobody else has purchasing power, cash is power. Cash is the ammunition that allows you to act when others are paralyzed. Before a recession, the number one strategy is to build financial strength. And that strength consists of 3 inseparable elements: sufficient liquidity, a personal balance sheet without imprudent debts, and the emotional discipline not to be swept away by panic or greed. Let me talk first about liquidity. In good times, holding cash can seem foolish. You see the market rising 10, 15, 20% a year, and there you are sitting with money that barely generates any return. Your friends look at you with pity. Experts on television talk about staying out of the market as if it were a cardinal sin. But when the recession comes, when prices fall 40, 50%, when solid companies sell for a fraction of their real value, that cash becomes your best ally. I'm not talking about fortune telling. I'm not suggesting you sell everything and wait for the perfect moment to get back in. That's impossible. What I'm saying is that you should always maintain a liquidity reserve that allows you 2 things. First, to survive without having to sell your investments at the worst possible moment. Second, to have the ability to buy when extraordinary opportunities appear. I've seen brilliant people with solid investment portfolios forced to sell at the lows of a crisis because they needed cash for basic expenses. They had invested every last cent. They had assumed they could always liquidate their positions without losses. And when the need came, the market was closed to them. They had to sell wonderful companies at terrible prices, crystallizing permanent losses. They never recovered. This brings me to the second element, the personal balance sheet. Debt is an accelerator. In good times, it accelerates gains. In bad times, it accelerates losses. And worse still, debt takes away your freedom. It forces you to make decisions you wouldn't want to make. It forces you to sell when you should buy. It paralyzes you when you should act. I'm not a purist who believes all debt is bad. There are productive debts, debts used to build, to create real value. But there's an abysmal difference between borrowing to buy a productive asset and borrowing to consume or to speculate. Most people who get ruined in recessions don't do so because their investments were bad. They do so because they were over-leveraged. They were playing with money that wasn't theirs, hoping everything would keep going up. When you have debts, especially debts with collateral on your assets, you live under the sword of the margin call, of the need to liquidate at the worst moment. When you have a clean balance sheet, when you owe nothing to anyone, you can wait. And in investing, the ability to wait is everything. I've built my financial life on a simple principle: never put myself in a position where someone else can force me to sell. The market is a wonderful servant, but a terrible master. If you give it the power to dictate when you buy and when you sell, it will destroy you. But if you maintain your independence, if you preserve your ability to choose, the market becomes your greatest source of opportunities. Now, you can have all the liquidity in the world and an impeccable balance sheet, but if you don't have emotional temperament, all of that will be useless. And this is where most people fail, not from lack of resources, but from lack of character. Recessions are economic events, but they are, above all, psychological events. They're tests of temperament. When markets fall 20, 30, 40%, when headlines talk of collapse and depression, when your friends are selling everything in a panic, your ability to stay calm and think clearly becomes your most valuable asset. I've seen this again and again. The same person who in calm times perfectly understands that a price drop is an opportunity, that buying cheap is better than buying expensive, in the middle of a crisis becomes paralyzed or, worse still, sells in panic. Logic disappears, fear takes control, and decisions are made not from reasoning but from the gut. Emotional preparation isn't something you build during the crisis. You build it beforehand. You build it by deeply understanding what you own and why you own it. If you don't understand the businesses behind the stocks you have, if you don't know their fundamentals, their competitive advantages, their ability to generate cash long term, then when prices fall, you won't have any rational anchor to hold on to. You'll sell because everyone's selling. You'll buy because everyone's buying. You'll be a leaf in the wind. But if you know what you own, if you've done your homework, if you understand that the value of a business doesn't change 10 times in a year even though its market price does, then you can withstand the volatility. More than that, you can take advantage of it. This is the paradox most people don't understand. Recessions are the prepared investor's best friend. They're the moment when excellent companies, those that are normally out of your reach because they're trading at elevated prices, suddenly become accessible. It's as if someone offered to let you buy $1 million house for $300,000, not because the house is damaged, but because the owner is desperate. But to take advantage of those opportunities, you need the three things I've talked about: cash to buy, a clean balance sheet that allows you to act without pressure, and the emotional fortitude to buy when everyone else is selling. Let me be more specific about what preparation means. It doesn't mean selling everything and sitting on the sidelines. That's as foolish as being fully invested without reserves. It means gradually building, during good times, a safety cushion. It means not stretching every dollar to the maximum. It means accepting that you're going to miss some gains in the short term to be prepared in the long term. I've always maintained significant cash reserves, even when that meant not fully participating in bull markets. People have criticized me for it. They've told me I'm being too conservative, that I'm leaving money on the table. And maybe they're right in the short term. But in the long term, that ability to act when others can't has been the difference between ordinary results and extraordinary results. I remember periods where companies I had admired for years, companies with solid brands, with clear competitive advantages, with excellent management, were suddenly available at prices I hadn't seen in decades. Why? Not because the businesses had fundamentally changed, not because they had suddenly stopped being good businesses, but because fear had taken control of the market and liquidity had disappeared. In those moments, having cash wasn't a disadvantage. It was the greatest possible advantage. I could buy significant stakes in extraordinary companies at prices that seem absurd today. But I could only do it because I had been patient, because I'd waited, because I hadn't spent all my ammunition in the good times. And here's another critical lesson. When you buy in the middle of a crisis, you don't buy expecting things to improve tomorrow. You buy with a vision of 5, 10, 20 years. You buy because you understand that you're acquiring a stake in a solid business at a ridiculously low price, and that eventually, when rationality returns to the market, that business will trade again at reasonable or even elevated prices. But to have that conviction, to be able to sleep peacefully when you've bought and prices keep falling, you need Deep knowledge. You need to have studied the business. You need to understand its moat, its competitive advantage. You need to know it can survive difficult times. Because if you don't have that conviction, you'll sell at the first sign of additional panic. Preparation, then, isn't just financial. It's intellectual. It's emotional. It's the construction of a complete system that allows you not just to survive recessions, but to thrive in them. Now, I know what some are thinking. They're thinking this sounds wonderful in theory, but that in practice it's impossible to know when the recession will arrive. So how can you prepare for something you don't know when it will occur? And there's the point. You don't need to know when it will arrive. In fact, it's better to assume you don't know and never will know. What you need is to always be prepared. Always. There's no switch you flip when you sense a recession approaching. There's a financial lifestyle, a constant discipline you practice. Every day, in good times and bad. This means you never overextend. You never take on debts you can't handle in the worst possible scenario. You never invest money you might need in the next 5 years. You never chase extraordinary returns at the cost of taking risks you don't understand. And you always maintain a liquidity reserve that gives you options. It's like a farmer who always saves seeds for the next season. He doesn't know if there will be drought or flood. He doesn't know if prices will rise or fall. But he knows that difficult times will come at some point. And when they come, he'll need resources to keep going and to take advantage of the opportunities those difficult times invariably create. The difference between a speculator and an investor becomes clear in recessions. The speculator is optimized for good times. He's fully invested, often leveraged, chasing the latest hot sector, buying things he doesn't understand because they're going up. When the recession comes, he's destroyed. He has no reserves. He has no balance sheet strength. He has no deep knowledge to give him conviction. He only has hopes, and hopes aren't a strategy. The investor, on the other hand, has sacrificed some return in good times in exchange for resilience. He's built a strong balance sheet. He's maintained liquidity. He's studied his investments deeply. He's developed the emotional discipline necessary to act contrarily when everyone else is panicking. And when the recession comes, he doesn't just survive. He flourishes. He buys what others have to sell. He acquires extraordinary assets at extraordinary prices. And when the storm passes, he emerges stronger than ever. I've lived through enough cycles to know this isn't theory. It's demonstrated reality time and again. The great wealth leaps, the great opportunities, don't come from chasing the latest boom. They come from being prepared when the inevitable bust arrives. And I want to emphasize something. This doesn't require being a genius. It doesn't require having inside information. It doesn't require making sophisticated bets or understanding complex financial instruments. It requires discipline. It requires patience. It requires the willingness to be prudent when everyone else is being reckless. Most people can do this. It's not a question of intelligence or advanced financial education. It's a question of character, of being willing to be different, of being willing to seem conservative or even cowardly in good times, knowing that prudence will become strength when times change. Because times always change. Markets are cyclical. The economy is cyclical. Human psychology is cyclical. And those who understand this, who prepare for it, who build their financial lives on solid foundations instead of on the hope that this time will be different, are the ones who prosper long term. There's a phrase I like very much that sums all this up. Only when the tide goes out do you discover who's been swimming naked. In good times, when everything's rising, everyone looks like a genius. Everyone has spectacular returns. Everyone brags about their gains. But when the recession comes, when the tide goes out, it's revealed who really knew what they were doing and who was simply being carried by the current. Those with liquidity, strong balance sheets, and deep knowledge of their investments remain standing. Those who were over-leveraged, without reserves, investing in things they didn't understand, get swept away. And here's something I want to make absolutely clear. I'm not suggesting you live in fear. I'm not saying you should hide under the bed waiting for the apocalypse. I'm saying exactly the opposite. I'm saying you should build a position of strength that allows you to live without fear, that allows you to act with confidence even when others are terrified, that allows you to see opportunities where others see only disaster. That's real security. It doesn't come from avoiding risk. It comes from being prepared to handle it. It comes from having the resources, the knowledge, and the temperament to navigate the inevitable storms that come with long-term investing. When I look back on my life as an investor, the moments I'm proudest of aren't the moments where I sold at the peak or bought at the exact bottom. They're the moments where I kept my head when everyone else was losing theirs. The moments where I had the discipline to do nothing when action seemed urgent. The moments where I had the fortitude to buy when everyone else was selling. And those moments were only possible because I had prepared. Because I had built, brick by brick, year after year, a foundation of financial strength that gave me options when others had none. So when people ask me what the #1 strategy is before a recession, I don't talk about complicated tactics or secret formulas. I talk about the basics, the fundamentals, what really matters. Build liquidity, strengthen your balance sheet, know deeply what you own, and develop the emotional temperament to act rationally when everyone else is being irrational. This isn't glamorous. It doesn't sell books. It doesn't generate headlines. But it works. It's worked for decades. It's worked through multiple recessions, crises, and collapses. And it will keep working because it's based not on temporary tricks or exploiting passing inefficiencies, but on fundamental and immutable principles about how long-term wealth accumulation really works. Recessions are going to come. I don't know when. I don't know how severe they'll be. But I know they'll come. And I know that when they do, they'll separate those who were prepared from those who were just lucky. You decide which side you want to be on.